All right, this is kind of the wrap up the entire course, and for a few weeks now you've kind of gotten into a little bit about taxes, investing, certain kind of aspects of balancing your money using a checkbook, and really this is by far the most important part of the class, because this is going to either interest you to go on to study money, or maybe you just decide, you know what, I'm just going to talk to my parents and kind of maybe use the methods that they've used that have been successful for them, which is totally fine. But I think you should really, as you get your education, as you go off and start making money, you should have a financial plan in place on how you're going to handle your inflow of money throughout your life and how you're going to handle those outflows. So the title of this PowerPoint is Fill the Asset Buckets, Not the Liability Buckets. And so before we kind of get into that, we need to understand, okay, what are assets and what are liabilities? Assets are basically represent ownership of value that can be converted into cash. So anything you have that can be converted into cash or provides a future economic benefit are considered assets. So personally, you know, your checking accounts, your saving accounts, your retirement accounts, vehicles, stuff that you own that you could sell, liquidate, and turn into cash are considered assets. Now, in businesses only generally produce or buy and make investment in the assets that are going to help them make more money in the long run. So that's why corporations have huge facilities, have tons of employees. They're able to grow because they make these huge investments in assets, and that's a very important concept. Unfortunately, individuals, especially Americans, we do not invest in assets. We basically create liabilities, and then we dig our way out of those liabilities over time. But when we create a liability is when we owe someone money. So the major liabilities that we take on are car loans. We might have credit card loans. So we're purchasing things and objects, material objects. Unfortunately, when we do that, they're not considered assets because they go down in value. So I want you to really think for a second, what are some things that you could purchase that will go up in value, and what are some things that you're going to purchase that are going to go down in value? And really, when you think about it, when you're in your 20s, instead of creating your balance sheet, because that's what this shows, if we take our assets, things that we own of value, that equals what we owe plus our net worth. And you've heard net worth. Net worth is basically your value as an individual. What is your net worth from a financial perspective? So if we switch around the equation here, we have assets minus liabilities equals owner's equity. And so young people make a huge mistake. They buy too many assets that depreciate versus buying assets that appreciate. To make matters even worse, when they purchase these assets, they create these huge liabilities. And so if we look at the equation here for a second, this number, the initial purchase, let's say they purchase a car, okay, so they create a $20,000 liability, they have a $20,000 asset. As soon as they drive that car off the lot, that asset no longer is worth $20,000. They still have the $20,000 liability. As time goes on, their net worth is actually going down because they've created a liability for an asset that is actually going down in value. So where I want your focus to be in, and I gave you kind of a small little path to follow. In year one, after you obtain your first job, do the following. The first and the most important thing, and you might even have this because you might have saved up money in your teenage years, during college maybe you saved a little bit of money. But basically the first thing that every individual, every household should have is build an emergency fund. This emergency fund is by far the number one important thing that you should have, and I'm gonna circle this sucker because that's how important I think that is. I'm gonna even put a star. There you go. There's my art ability right there. Because if you build an emergency fund, the way we define emergency fund is 6 months of living expenses saved up in a liquid account. That way, if you lose your job, you get sick, you have unfortunate bills that pop up, you dip into that emergency fund to handle those emergencies. You never have to go to the credit card company and borrow at 25-30% interest. All right, so by having this emergency fund is very key to your financial success. And every year as your income goes up, or your expenses go up, you want to adjust that emergency fund. Limit your exposure to liabilities. So try to stay away from liabilities in your 20s as much as you can. Now, you might not be able to get away from school loans. that is fine. That's an investment. In business, we call it an investment because that education is going to provide you with more income throughout your life than you can ever imagine. You just got to make sure, though, that that education and the training that you get is worthwhile and it equates to a career path. Don't go out and major in something that is not going to lead to a job. You're wasting 4 years of your life studying something, and it's not going to help you with employability. That's why we did that career unit first, is to get your career path down, to really think about that. How are you going to make money? Okay. Then the third thing, don't use credit card debt. Stay away from this as much as possible when you're young because you want to build that credit score. Okay, so stay out of it. My advice is get a credit card when you go to college. Maybe use it once or twice a month, pay off the bill entirely, and then you're going to slowly build a good credit score. Okay, so year 2, evaluate your career choice. Really think about it. Are you in the right career? Are you happy with what you're doing? Are you ready to move forward in that career? A lot of times you get that degree, you get into a job. Don't get stuck in a career that you don't like. You're young, you have no responsibility. Really take that first year to explore that career, make sure that it's solid. You should be spending that time in college, though, exploring that career. Therefore, you won't go into something. I've ran into way too many students around this town that went into something, didn't like it, and now they're 25, 26, and they're going back. They should have figured it out a lot sooner than 26 years old, because time is money, and they have to kind of now they're basically going to get retrained. They're going to come out as a 28-year-old, and they're going to be competing against people that are 21 and 22 right out of school. And then the question is, well, what's going on here? So really evaluate that career choice closely. Now, you get the job, you start getting your paychecks. This is what you're going to do. You're going to create investment buckets. And what you want to do is you want to start filling those investment buckets with money that you're earning. Instead of taking that money that you're earning and going out and taking on liabilities and just spending it, now you have assets that are going to go up in value over time. So into the future, you're going to actually have a cash flow from these assets. Year 3, continue to evaluate that career choice, and now start filling up those buckets. Same thing in year 4. So every year you're always evaluating your career choice, always evaluating career options. Start filling those asset buckets if you're going to continue with that career choice. So now you get a little more aggressive. In year 4, you're stable in the career choice that you have, and you're getting more aggressive with filling up those buckets. So what can we put into these investment buckets? We could put stocks, which you studied a little bit. You could have your own trading account. You could, just like with Investopedia, you could do that through an E-Trade, SureTrade. 401ks for your employer, Roth IRAs, mutual funds, index exchange-traded funds are a few of types of ways you can invest in stocks. Bonds, life insurance contracts, real estate. Not real estate that you live in, but real estate where you rent out to other people. Or you could do what's called a real estate investment trust. Is another option to invest in real estate without having to do the day-to-day operations of managing the property. You could do options, commodities, real estate, small business investor. I have real estate on there twice. So one is really, should say, REITs, and then the other one is direct investment in real estate. But there's a lot of different ways you can go with real estate. You could become a small business investor. You can invest in other people's businesses. You could trade currencies. There's so many different investment choices out there. My advice is try to pick a couple and really study them and become an expert in those, and then that's what you want to fill your buckets with. I can't go back. I'm going to go back to this slide because this is important. And I'm going to draw a little picture here off to the side and do the best I can. This is the mistake that 20-year-olds make. If I were to draw a chart right here, okay, I'm going to draw my little chart. And the X is time. I'm going to draw a T for time. And then the Y is going to be money. I'm going to look at that. I'm doing the best I can. I'm using the I'm not really using a mouse right now. Okay, so when you're young, you don't make a lot of money. Okay, so your income is generally low. Then gradually over time, you get good at what you do, and then your income starts to rise up. And then a lot of you guys are seeing your parents at the peak of their earning potential, so they're a little bit higher. So this is the hope for most people. Okay, so if you're a trained professional and you're truly valued in your field, your income is going to go up over time. Now here's the mistake that a lot of people make. As that income goes up, this orange line that I'm going to draw is going to represent expenses. And what they do is, as the income goes up, they increase their monthly expenses. They get a bigger house. They take on more liabilities. Okay, so the difference between these two lines represents the amount that you have available for investment. And as you can see here, it's very, 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 very little here. So what you want to do in your 20s, this is what I recommend you do, and really think about money this way. Once again, I'm going to get the red is your income. So I'm going to draw a line that's kind of similar, all right? And then the orange is going to be your expenses. Try to keep your expenses in check when you're young. Get used to living a certain way, and kind of keep the expenses level. And if you look now you're going to have more ability here, more green. And if we look at this aerial here, let me color it in the best I can there, and scribble, 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 scribble. And as you can see here, you're going to have more dollars to invest in assets that go up in value. So you're going to reposition these dollars into assets, and your assets over time are going to do this. And so then at the end of the day, not only you're going to have a high savings rate, your assets are going to perform very well for you. And you're going to have more money than you're going to know what to do with, and that's, you know, that's a great situation to have. But if you go into your 20s, and this is unfortunately what a lot of young people will do, is their income does this, and then they start taking on all these liabilities, and that line almost matches the income line for that decade. So for that decade, you have very little money to invest and to start filling these buckets with. Because at the end of the day, we want you to fill these buckets up. And that's kind of the goal. So really think about that, ponder that. And what I want you to do is I want you to kind of watch the next video. I have 2 videos. The next one talks about how you could use your home, your equity in your home, to reposition that. And that's kind of a heavier concept, and it isn't for everyone. But the goal is to make investments that go up in value. Now, a lot of people out there say, you know, stock market makes me nervous, blah, blah, blah. That's why you have to study finance. You have to study money. You have to study the investment choices that you're making. It's kind of like I'm going to study to become a actuary, but I don't like you know, I don't like math, or you know, I don't want to do my homework. It just doesn't make sense. I'm not going to become an actuary if I don't do my homework and study math. Well, the same thing with money. Your wealth isn't going to go up unless you study something, unless you study how money works and you study how investments work. Otherwise, you're going into it blind. And at the end of the day, I told you this in the first day of summer school, I want you, A, to wake up every day excited about going to work in your job that you have, and 2, never having to worry about money. So you need to study money. Now, what can you do? You could read MSN Money. I gave you an assignment a couple units ago on that. You could look at different Yahoo Finance has great articles on there. You could take at Deerfield, we have an investing class. Your universities all have personal finance classes that you could take as electives. So really get out there and start, you know, studying money. You spend all this time training in an area to become proficient so you could earn money, which is great, and that's exactly what you should be doing. But really, you should also include in there is a financial plan. First week, I read a lot of your forums. You guys said, you know, a lot of you guys are into music. You're musicians. You're in orchestra. You're in band. A lot of you guys said, I just want to do something with music, and I want to, you know, have a family, and I don't, you know, and you had kind of this basic premise, which I thought is great, but at the same time, though, you can't ignore studying money. You have to have a financial plan there. And so you have to start thinking of these things. And if you have a good financial plan in place, you could spend all the time you want playing music, listening to music, teaching people music, doing whatever. And that's the beauty of money, is when you don't have to worry about money, you'll have time to do other things, and you have the means to do the things that you want. So just kind of think of that. Okay? All right, I'm going to show you one more video. It's a little more sophisticated, but I want to throw a couple things out there to kind of challenge you a little bit on your thinking. And at the end of the day, I hope you fill your 20s I travel, do all the things that you want to do, but make sure you fill some asset buckets up. Don't ignore these buckets, because the longer you wait, the more money you're going to have to put in down the line, and you might not have that money down the line. So it's important that you start doing it young, and that you have the ability to do it when you're young. Okay, thank you.